Hi class, this is Professor Barati, and I'm sending you a video to discuss Project 2, the Financial Assessment Case Study, which is the next case study that's due. And the Financial Assessment Case Study is basically a nice case study on a small business, a small company, that is having some cash flow issues and working capital issues. As you've learned, working capital is basically the current assets minus current liabilities, which is called net working capital. And it's kind of the source of all cash flows for companies, how well a company can manage its receivables, its inventory, its payables. So I'm going to go over this case study because many of you have not come across this type of case study before. And I admit that it's not an easy case study, but what's going to be graded on this case study is your approach to it, how you think things through, what areas of the income statement and balance sheet that you focus on to help understand the problem first, what's causing it, and second, how to solve it. So, the questions here that they want is, why is Clarkson Lumber borrowing increasing amounts despite its consistent profitability? So what we've learned basically is profitability does not necessarily translate into cash and working capital. A lot of that profitability will get tied up in current assets and liabilities. How has Mr. Clarkson met the financing needs of the company between 93 and 95? Do you agree with Mr. Clarkson's estimate of the company's loan requirements, which is stated in the case study? How much will he need to finance the expected expansion in sales to $5.5 million in 1996 and still take the trade discounts of 2%? As his advisor, would you give him the go-ahead or reconsider his anticipated expansion? So what you have to do is look at the historical financial statements that are presented in the case study and do a pro forma based on some of the ratios that you've already done. And you're going to come up with a pro forma based on 5.5 million in sales. And you're going to take the trade discounts of 2%. Finally, as a banker, would you approve Mr. Clarkson's loan request? You must do it in most likely a Word document. I certainly will take Excel spreadsheets as backup. You can even do some PowerPoint slides if you want. So what you want to do is not spend a lot of time embellishing and wasting time on things that are not important. I think you want to get right to the case. This is the case study, the Clarkson Lumber Company. The final case study will be this finance simulation. Many of you will try to get into the simulation and get a note that the professor hasn't assigned a simulation yet. I have not set this up yet for the students. You must enroll in the publishing for me to know to set it up. So if there's only 1 or 2 students, I really can't set up the finance simulation until everyone is registered, which you will do with this Clarkson Lumber. Once everyone is in the Harvard publishing, I'll be able to set up this finance. But we're concerned about Clarkson Lumber. And although I have the advantage of an educator copy and a teaching note, I'm going to share some of these teaching notes with you to give you some good tips on how to approach this. I'm also going to share the spreadsheets with you and send them to you so that you don't spend a lot of time setting up the spreadsheets that are already in the case study. You're going to get an income statement, a balance sheet, and Exhibit 3. What you're not going to get is a cash flow statement. I believe that's in the case study, but you don't have a spreadsheet. So let's go over some of the Clarkson case study. Clarkson has been expanding rapidly for years. Increases working capital requirements have outrun the capacity of the company to generate funds. Part of the company's available funds have been used by Mr. Clarkson to buy out his partner, thereby further increasing financial pressure. The company has been forced to forego taking discounts on accounts payable and to borrow increasing amounts from the bank. Mr. Clarkson must decide whether to continue to expand, and if so, how to raise the funds. The alternative that he is actively considering is to seek a new bank connection for which he can borrow larger but secured amounts from his present bank. The Clarkson case can be used for many of the same purposes as the other introductory cases in finance. The objectives is to ascertain why the Clarkson company is short of funds despite its record of profitability, to evaluate Mr. Clarkson's estimate of his loan requirements, decide what size loan the company needs and when it can expect to repay his loan, to explore the wisdom of proceeding with a rapidly expanding level of operations. All of these endeavors provide practice for students in developing skills in elementary financial analysis and in sizing up financial problems. A good place to start the discussion of the case is with the question, why does Mr. Clarkson have to borrow money to support the profitable business? A convenient method of summarizing what has happened during the past several years is to draw up a condensed statement of cash flows. You can get that from the balance sheet. A statement of cash flows is basically the changes in your balance sheet. But rather than spending a lot of time figuring that out and preparing this statement right here, I am providing that for you with this video. So here's the cash flow and operating activities, 1994 and 1995. And that's based on this balance sheet of 1994 and 1995. You can extend it through the first quarter of 96. Cash flow from operations. Notice that every year it's been negative, and for 2 years it's a negative 82,000. We have good net income, positive net income, but notice receivables have been increasing. They've been increasing, which means it's using up working capital. We're not collecting our receivables as fast as we should. Notice that inventories are increasing, meaning that inventory turnover might be slowing down rather than improving. Even though our sales might be growing, we're not turning over our inventories enough. Notice that increase in trade payables have increased over time. In other words, we're not paying our vendors, our suppliers who help us with inventory, who give us the inventory. We're not paying our suppliers fast enough. So we're basically financing some of this growth with our suppliers' money. So the increase in accounts payable is increasing, which means we're not paying our suppliers. We're using that working capital to generate our growth. Same with accrued expenses. But when you add up all these changes in working capital, we have a negative $82,000. So how did we finance that $82,000? Well, we added more working capital pressure by buying more property, plant, and equipment, especially in 1995. So we used working capital to buy more property, plant, and equipment. This is important for growth. You have to maintain your property, plant, and equipment, modernize it or update it to generate this net income. So now our working capitals become even worse with the negative 82 and the negative 155. So how do we finance it? Part of it is with the payables, and then the rest is in this financing activity section. We borrow money from the bank. But on top of that, we had to pay off a partner to get by their interest. And then we took proceeds from a buyout of financing of $200K. These proceeds will likely not occur again in the following years. We paid down some debt, and we also did a buyout of debt. So net cash flow from financing the opportunities with $250,000. And that's how we are basically financing it. We're going into debt. The statement makes it clear that rapid increases in receivables, inventory, plant, and equipment have been responsible for the working capital issue. Here's a nice table that shows why the receivables are going up, that we're not collecting. Notice our collection period days are increasing. We went from 38 to 49 in Q1 of 96. Notice receivables as a percent of sales has been going up. Notice our average inventory turns have been declining. That explains this section right here. You see the correlation and the relationship. Students should be able to explain why companies invest in inventory if, as is usually the situation, inventory is to support the level of activity for the time and period. You could talk about net property as a percent of sales. Turning into the investigation of Clark's recent financing decisions and to an assessment of financial strength. Clarkson's financial condition has weakened. Trade credit has been stretched from 35 to 54 days. Total liabilities as a percent of total assets have soared from 45% to 72%. Total liabilities as a percent of total assets has gone from 45 to 72%. Days payable has also increased. We are taking longer to pay our vendors. And notice our current ratio has declined. All these are ratios that would basically indicate a liquidity deterioration of our balance sheet and operations. Mr. Clarkson has determined that a line of credit of $750 would be sufficient. You need to basically get a feel to determine if that's accurate. Remember, I'm not grading on the accuracy of how much money you think Mr. Clarkson should borrow to pay for his operations. What I am grading on is your approach. How did you approach this problem? Did you determine that he needed more money or less money, and why? And back support it with calculations and relationships between the income statement and the balance sheet. Again, critical thinking is what we're looking for. Also keep in mind that Mr. Clarkson continues to rely heavily on trade credit as a source of funds, which I have indicated right here. His trade credit is his accounts payable. Mr. Clarkson would like to take advantage of the 2% discount offered on payments made within 10 days, providing he has the financial flexibility to make this choice freely. His decision probably should turn on the implicit interest rate he is paying by not taking purchase discounts. Mr. Clarkson is offered a discount of 2% for payment made in 10 days and does not in fact pay until 50. What interest rate is he paying by foregoing his discount? They give you that right here. So what you want to do is do a pro forma statement based on 5.5 million. And based on the income statement, what I would do is look at the percent of sales that these items are on the income statement. So for example, total cost of goods sold for each period is going to be total cost of goods sold, the gross margin for each period is going to be the gross profit divided by net sales. I'm getting a value there because there's probably an A in there that is explained on the bottom, so let me take that out. Notice that the gross margin on net sales has been pretty consistent. That's the kind of approach I'd like you to take. Look at the relationships. The average is 24.46. The problem wants you to do a pro forma for 1996. So you can estimate that 1996, they're saying, gives us $5,500,000 in sales. From there, you can generate your total cost of goods sold as a percent, your gross margin as a percent. So if you get your percent, you can basically figure out what your net income is going to be. Another approach is I would take the percents averages that your balance sheet is on your net sales from your income statement. Look for the relationship. Or you can do what some students do. They go back to the calculations of collection periods, and you can use your day sales outstanding ratio to figure out what your accounts receivable is, or use receivables as a percent of net of sales. You can calculate your average inventory and your year-end inventory based on the turns. So you could do your balance sheet that way by taking into account beginning inventory, ending inventory, okay, what your turns will generate in inventory, come up with your purchases and so on. You could back in that way. On your balance sheet, you could take into consideration the percent of sales. Keep in mind these areas here, term loan, current portion, that's going to stay constant. that is not that doesn't have a relationship to sales. As sales go up, your term loan isn't going to change. And they tell you that interest is fixed at 10% times the outstanding balance. So your term loan looks like it's going down $20,000 a year. So you could adjust this by 20 grand, apply your interest rate, and so on. A note payable looks like that's all gone. So you really just have to focus on these areas to estimate what they would be. Another thing is property, plant, and equipment. You could basically say to generate $5.5 million more in sales, I'm going to have to buy more property or more equipment. So I'm going to find a percent of this. And that'll give you your balance sheet. Your balance sheet is not going to balance. It can't, because it's all estimates. So how you will balance it is your revolving line of credit, which is this note payable. That's going to be your plug. Also, this gives you some of the percents, highs and lows, that you could work with. Total percents to help generate your balance sheet. The balance sheet obviously is a little more subjective, and therefore will be less accurate. So this will be your plug. And if you go into the case study here, it does some of that. It takes the receivables as a percent of net sales and adjusts that. And it also shows you, let me see if I can get to the statement, cash flow statement on here. It looks like they don't give us a cash flow statement. They only give us for the last 2 years. But this overall should help you decide if you need to borrow more than the $750,000. So I'm going to send you these exhibits, so it'll make it easier for you to generate your formulas. You can insert formulas in there to do the percents and so on. I'm going to take this out, or not save it, so you'll get the original. And that's basically a good summary and approach. It seems very and it seems very difficult and intimidating because there's a lot of information. But all this is nothing but a big liquidity analysis using your liquidity ratios, taking the estimated income statement based on 5.5 million and figure out, if you want to take the 2% discount, which I recommend you do. And you might say something like, in order to do a 2%, take my discount on my payables. Okay, my payables, I want to get back to the 35 days to do that instead of 54. To get back to 35 days, my payables, I'm going to have to reduce my payable balance sheet. This payable might have to come down accounts payable might have to come down less than the percent of net sales. So that's the kind of thing that, I'm going to basically say, this student is thinking things through. They want to take the 2%, perhaps generate more profit. By taking that 2%, they can generate less interest expense. By taking the 2%, they can generate a higher cost of goods sold. A lower cost of goods sold, because now their purchases cost less by 2%. You can knock 2% off your purchase. But just remember, if you knock 2% off your purchases to increase your gross profit, you have to flow that to the balance sheet and make sure your accounts payable is based on closer to 30 or 35 days. Or you can ignore it and just take the percent of sales. But either way, this is going to be your plug right here. You're not going to know how much money you need to borrow. This is going to tell you. If this ends up being greater than $750,000, you have your answer, and you can recommend going forward. So that's a quick summary of the case study for Clarkson. I recommend that you look this over and reading out. I'm giving you a lot of information that, as you notice, this is teacher notes. I don't have to provide that. So I've given you a lot of information to help you figure out and get you moving along so that you don't spend a lot of unnecessary hours figuring out the right numbers. Thanks for watching.